Hey everyone, happy June. We see everyone joining in here. We'll give it a minute or two for everyone to jump in and then we'll get going. All right. It looks like the numbers are slowing down, so we'll get started here. Again, everyone, happy June. Welcome to our June 2025 market commentary. You might notice we have a new face here with us. Amanda joined our team recently, and we are extremely happy to have her. Um, and Amanda, how about you introduce yourself a little bit?
Yeah, thanks, Evan. And hello, everyone. Nice to, see everyone rolling in today. Happy Friday. As Evan mentioned, my name's Amanda. I am new to the team, but not new to financial planning. I do come to the team bringing about 8 years of experience. I am also a certified financial planner, as you can see on the screen. I do reside in the Cleveland area. So happy to join the team and just be an extension of everyone, and also just to get to work with all of you going forwards. But I will pass it back over to Evan to start the webinar.
All right, great. Amanda, great to have you on the team. So here's the agenda for today. We'll start with a quick stock market update. We'll move into a bond market update. And then just like our last commentary, we'll open up to a little live Q&A. So where are we now in the stock market? It has been a volatile year where earlier in the year, it seemed like we were getting notifications almost every day on updates to the stock market and tariffs and things along those lines. But we've seen those news breaks come out a little bit less frequently. So markets are a little less volatile today than they were a few months ago. But where are we today? So if we look year to date in the S&P 500, S&P 500 is about up 2% on the year, which is interesting because it wasn't that long ago where we saw some significant losses in the S&P 500. But if we break down the S&P 500 a little bit more, the value is up 3% year to date, and the growth is only up 1% year to date. If you've been joining in our commentaries for the last couple months or even year now, you'll know that our philosophy is a little bit more on the value side, which has done well for us this year. And then another interesting thing that sticks out to us is the international stock market. International stock market, iFund, things similar to that are up 18% year to date, which is something that we haven't seen for a very, very long time, where we've been avoiding the iFund within the TSP. We've been underweight international in our portfolio for the last 5, 10 years, which has boded well. It hasn't been a great performer during that time period, but this is why it's important to be in a diversified portfolio where sometimes different asset classes outperform others. And that's going to show this year that international is up 18% year to date. Another thing that sticks out on this chart is just the 3-year average in the US stock market, where these are pretty, I don't want to say unprecedented times, because during from 2010 to 2020, we saw some great returns in the S&P 500, but averaging 14, 15% going forward is not really something that we see as a strong probability, but just a reminder that we have done pretty well over these last 3 years.
And one thing that I noticed here, Evan, looking at the year to date is, right, the small companies are still negative, right? We've still see some red in that box. Now, for those of you who are on last month, or you might remember this, but last month when we showed this, some of the small companies were down 12 to 14%, right? So we still see that they are negative, but silver lining there is it looks like they're coming back.
Yeah, and to that point, I think the main reason for that big downpull in the small cap side was they weren't really prepared well for the increase in tariffs, increase in inflation, increase on the cost of goods to do business. So that's why we saw a big drop with the small cap earlier on in the year when the expectations for tariffs were going to be 30%, which we haven't seen in over 50 years. And that's even the large cap companies, they felt it, and we saw the correction with them too, where they weren't totally prepared to handle that big increase in tariffs and inflation. But now the new maximum tariff estimate is 15%, which we still haven't seen since the 40s. But the companies in the US are adaptable. They'll find other ways to do business. They'll find other countries to import those goods from. So we do see that with this new maximum tariff estimate, companies are prepared well to deal with those.
Yeah. Just wanted to pitch in. I've seen a handful of people join, a decent number of people join since we've started. Just so you know, for those of you that are on live, this is recorded and it'll be up on our YouTube channel. So if you missed the beginning, you can always go back and watch that there. The other thing that I want to say, before we get too far, is any questions that you guys have while we're going through this, type them in the Q&A. Type them in the Q&A box, even if they're not necessarily related to what we're talking about here. If something strikes you, type it in the Q&A box. We'll have a whole session on that at the end to answer any questions that you guys have. So get those in there. And if you're thinking it, somebody else probably is too. So make sure to get those questions in. So, all right, back to the presentation here. If you've been keeping track of anything we've been talking about over the last year and a half, we've had this pretty consistent message that we want to be mindful of the prices we're paying for our investments. Okay, and we've been thinking they've been feeling a little high lately. Okay, and so just to recap, price to earnings ratios, PE ratios, what does this mean? I know we talk about it a lot, but some of you haven't heard us yet. So price to earnings ratios is what price are we paying for every dollar of earnings a company is making. So it's a way to look at companies across the board and say, how expensive is this? Okay, if we're paying $20 for every dollar of earnings a company is getting versus $15 for every dollar of earnings, there better be a good reason we're paying 20 times the dollar instead of 15 times the dollar of earnings, right? There's better be a good reason there. There better be a lot of growth projected into the future. Now, when we look back, throughout the late 90s into the 2000s, what we've been paying over time, you can see this trend, right? The market's been climbing. Everybody wants to be involved in that growth. And so people have been piling in and it's been driving prices up. So let's look at the next slide here and look at what price to earnings ratios have looked like over time. You look back again through the 90s, and the S&P 500, you can see here, is traded in a pretty large range. Okay, but historically, there's this bottom kind of floor at 14 times earnings and a cap around this 20 times earnings, where if it falls below 14, that's typically signaling at a bottom of the market. Things are too cheap. We're going to see some increase in that. When we start to see things trade over 20 times, we see that in the late 90s, and then we see it happening now. And we see it, we don't last over 20 times for very long. People start to decide that's too much to pay, right? Either earnings don't keep up with expectations, or people just get tired of paying that extra cost. Okay, so right now we're sitting right over that 20 times mark. All right. Now, if we move on from here and kind of see how this is impacting things, or how this impacts, or how this has impacted the market in the past, there's a relationship. And if you look at the chart on the right, if you look at things over 5 years, there's actually a pretty distinct relationship between where the PE ratio is, so what that multiple is, and then how, what the returns are going to be over the next 5 years. You see, there's a pretty distinct trend here. Okay. And what the trend says is that the higher the price is now in relation to the earnings, the lower the next 5 years of returns will be. Okay. On the lower end of the spectrum, right, when we're trading at 14 times price to earnings, we're expecting something like, 10 to 15% returns for the next 5 years. When we're at 21 times where we are now, the expected return over the next 5 years is, closer to 5% a year. Okay. So how, we talk about this a lot, but how is this playing into the decision making within our portfolio? Okay. Evan mentioned this at the beginning on one of the first slides, that we've taken a very, very concerted effort to balance out the growth and value companies within our portfolio. The growth companies are sexy, right? They're the ones everybody's talking about. It's Apple, Amazon, Facebook, everybody that does AI, right? And there's this extreme optimism around these companies right now and how they're going to transform the world. And some of that, might be warranted, okay? But when we look at the price we're paying for these on the growth side of the market, we're paying 27 times earnings. To put that in perspective, right? That would be like if you wanted to buy the coffee shop down the road that was making $100,000 of revenue each year. Okay. That would be like going in and offering that coffee shop $2.7 million for the coffee shop that's making $100,000 a year. Now, the only logical reason that you might do that is if that coffee shop had some extreme growth track record and you thought they were going to continue growing, so it wouldn't take you 27 years to make your money back, right? That's the way we need to think about these growth companies right now is, do they have the earning potential to actually warrant paying 27 times their earnings? Okay. Now, on the value side, we're at 16 times. Okay, when you use the coffee shop example, paying 1.6 million for a $100,000 of revenue, that still feels like a lot for a coffee shop. But when you put this into perspective and you think about these companies being, Costco, Home Depot, Procter and Gamble, McDonald's, right, that have a consistent track record, they're pumping out cash. That gets a little bit more reasonable, and that's well within the historical average. Okay. So maintaining a balance of growth and value, that's very important to us. Now, this is the US market. We talked a little bit about international as well. Another thing that's really caught our attention, and we've been paying attention to this for the last couple of years, but it's been difficult to really jump on it just with the underperformance in international. But the international market is significantly discounted when you look at it from a price to earnings standpoint. Okay. So for every dollar of earnings an international company makes right now, we are paying 34% less for that. Okay. For every dollar of revenue, just because it's an international company, we're paying 34% less to own that dollar of revenue. Okay, so right now we're the US, we're trading at 21 times earnings currently, international markets at 14 times. Okay, so now to put this in perspective, the international market normally trades a little bit lower than the US market. Okay, US, if the 20-year average is 16, international is 13. And I also want to be clear here that we're not saying, for all of you feds on the call that are in the TSP, we're not saying go run to the iFund and dump everything in there. Okay. There's still plenty of risk with the international market. There's still reason that we favor the US. And there's still reason that we favor, and this might be something that we can get into when we answer questions and whatnot. But there's reason that we favor specifically actively managed international funds rather than just owning a broad international index like the iFund. But that's something that we can get to later on. But this is just, it's interesting, right? For those of you that are in the TSP that are going to be in there, you don't have options to move it out yet. Having some iFund exposure, is starting to make some sense. For those of you that have money outside the TSP that we're managing for you or that you're managing otherwise, in our models, we're including more actively managed international. That's something to consider as well. So
Just one
yeah,
more
Evan.
dimension there is when you look at the benchmark in a fully stock market portfolio, what would you say, Austin? Like 20 to 30% total international is the benchmark?
Yeah, like the life cycle funds usually have 20 to 30.
Exactly. So we've been, as I mentioned earlier, we've been underweight. So not doing that 20, 30%, a little less than 20%. But as of recent, we've gotten back to the benchmark. So we're not overweighting international, just getting back to that benchmark, just because we see that as an opportunity going forward. Not overweighting it, just getting back to the benchmark.
Good clarification. Thanks.
So that was the stock market update. Now let's get into the bond market update. So how are bonds doing right now? Where are we today? So if we look at the bottom left box, where are we year to date with bonds? Bonds are doing their job. Where if we look at a fully diversified bond portfolio, we're up about 3% on the year. And I've had a lot of clients ask recently, how do we view bonds? Do we see them as a risk and we should run away from bonds? Do we see them as an opportunity? Is it more of a buy and hold and bonds are going to do their job? It's the latter, where if we're in a moderate portfolio, we're not running away from bonds. We view them as they're going to do their job. Yields are good right now, and they're going to be the ballast of the portfolio and be that conservative investment that they should be. But I think the reason people are asking, do we view bonds as a risk, is because of inflation. And inflation is always the risk for bonds, where we know that there's an inverse relationship between interest rates and bond values. So if interest rates are going up, that means that the value of your bonds is going down. So if interest rates and inflation go up, that is a risk to bonds. But I like to go back to what happened in COVID. And during COVID, we saw a pretty unprecedented increase in interest rates, where we were pretty much at 0% interest rates and jumped up to 5%. That's a significant percentage increase. And what led to that? It was a couple of different factors, but the factors that really impacted inflation back then was core goods and energy. We can see that core goods added about 2% to inflation, and we can say that energy also added another 2% to inflation. So what do we see as a risk going forward due to these new tariffs? We view that the risk is to the core goods, where we could see an increase in inflation due to those core goods and tariffs. But it's not a perfect comparison from COVID to today, but it's the best that we have to go off of. So let's assume that going forward, core goods do add another 2% to inflation. It's not going to be as dramatic as it was a couple of years ago, because a couple of years ago, we were essentially at 0% interest rates, basically zero. And then we saw a huge jump to over 5%. So let's assume it was at 1%, which it wasn't. That's a 5 times increase. So for us to see bonds perform like they did during COVID, we would need to see interest rates go all the way up to 15% past, which we really don't view as a likelihood. But this is an interesting graph, seeing where the expectation for interest rates going forward is. And the Fed really wants to get to 3%. That is the end goal. And it's interesting to see that even with all these new announcements, the expectation is that interest rates are still going to decrease. And the Fed had a recent meeting, and this has been the theme over the past couple of months, is wait and see, where they're going to see how tariffs impact inflation and adjust rates accordingly from there. But it is interesting and optimistic to see that the trend for interest rates and expectations is still going down. And what do we expect as a return standpoint from bonds going forward? If we look at history and we look at when yields are at 4.71%, which is where they are today, we can expect about a 4.8% average return on the 5-year. And that's not being up 4.8% after 5 years. That's 4.8% annualized year after year, which is really what bonds are supposed to do. And that's why they're the ballast of the portfolio, trying to get more than what you're getting in your high yield money market savings account. As that one bump up from those types of accounts, we view that bonds are going to continue to do their job going forward. So a couple of final thoughts here. It was interesting to see that consumer confidence is still extremely low as of the end of May, where you would have thought that consumer confidence has gone up after the tariff expectations lowered. There aren't as many news breaks anymore. The stock market has recovered. You'd think that consumer sentiment would be a little bit higher. So that was interesting to see. But with that theme, and we look back through history, whenever consumer confidence is extremely low, the 12 months of returns going forward have been very well. So we look back in 2003, just after the dot-com burst, and people did not have a lot of confidence in the market. The next 12 months, the stock market was up 32%. When COVID hit and we didn't see the end of the tunnel, everyone was nervous going forward. The next 12 months, stock market up 43%. And if we look at when consumer confidence is really high, then we see the opposite, where 2024, after that great year, after people were scared, and then people saw that great year in the market, people wanted to jump in when things were raise the sunshine. We don't see great returns going forward after there. So it's a common theme and the golden rule, and it's easier to say than to actually do, is buy low, sell high. When things are red and things are scary, that's the time to buy at a discount. And when things are green, everyone's making money, that's the time to think, maybe should we take some chips off the table and rebalance our portfolios.
Warren Buffett has one of my favorite quotes about investing in that way, and he says, "Be greedy when others are fearful, and be fearful when others are greedy."
That's a great quote.
If you followed that advice in the market, you would win a lot more than you lost. It's the market typically moves the opposite of the way that people's emotions are telling them it's going to.
Exactly. This is another really interesting graph and something to keep in mind, where I've had some clients ask me recently where they just left the federal government and things were scary in the stock market, and they moved everything to the G fund. And they asked, I don't think I'm a long-term investor anymore. It's time for me to start withdrawing my money down. Well, that is true. We do need money on the sideline, not in the stock market for withdrawal needs, but we're also talking about 30 years of distributions. So you still are a long-term investor. And it's really interesting to see these different returns over different time horizons. So what we're looking at here is the green bars, or if you're totally invested in the stock market. The blue bars are if you're totally invested in the bond market. And then the gray bar is if you're in a 60-40 portfolio, meaning 60% in stocks, 40% in bonds. And if we look at a couple of things stand out to me on this graph. Number one is the best case scenario and worst case scenario. If you're in stocks for 1 year, best case scenario, you can go from 1 million to 1.5 million. That's a pretty stark return. But on the flip side, you can also go from 1 million to 600,000. So that's one thing that sticks out to me and why we need cash on the sidelines for withdrawal needs when we start to have those withdrawals in retirement. But another thing that stuck out to me was if we look at the 5-year average and best case and worst case scenario for a 60-40 portfolio, best case scenario, we're averaging 20% year after year for 5 years, which is a great best case scenario. But worst case scenario is we're averaging 1% each year. So 1% for each of those 5 years is the worst case scenario in history since the 1950 in a 60-40 portfolio. That really stuck out to me where it goes to show that we do need money on the sideline and cash for those withdrawal needs. But anything above and beyond that, if we're talking about 5 years, history tells us you won't lose money over that 5-year time horizon. Anything else here on this graph that sticks out to you guys? Those were the big ones for me.
No, I think that's really interesting. The other thing that sticks out to me is the biggest 1-year drop being in bonds being 13%. I'm fairly certain. I don't have that. I'm not looking at the data on this, but I'm fairly certain that 13% drop was 2022.
2022.
Or yeah. So, it was just recently during that crazy spike in interest rates. So when you look back through the whole rest of the 50s from 1950 to 2024, like that was a black swan type of event for the bond market. Now, just this is just another sidebar. There's been a lot of talk about the federal deficit and our do we still want to be in government bonds and things like that. We have to remember that a lot of the bonds that we're purchasing are actually, some of them are from the government. If you're in the G fund, that's 100% government bonds. But like the F fund or other bond funds that we're purchasing, those aren't even from the government. They're from companies. It's loaning money to companies so that they can continue to grow. And that's what we're doing in the bond market. So we can diversify in bonds just like we can in stocks. But I just thought that was interesting that negative 13% was very recent. And if you were to actually eliminate that year, I would imagine, honestly, it's probably under 10%, probably closer to 5%, I think was the largest drop before then.
Mm-hmm. Yep. And then one more thing that sticks out to me here is the bond returns. Like for a conservative investor that says, I really don't feel comfortable with those swings in the market, I just want to be in bonds. Yes, there's more principal protection, but when we look at the 10-year, let's look at the 20-year. If we were just in bonds for 20 years, the worst case scenario there is 1% per year, which is, it doesn't sound bad, but when you're extrapolating that 1% out and accounting for inflation, being a conservative investor didn't really pay off. Versus if you were in a 60-40 portfolio, pretty big difference going from 0% in stocks to 60% in stocks. But what also is a big difference is going from 1% worst case scenario per year to 5% worst case scenario per year, where if we're compounding that 5% versus that 1%, that would be a pretty stark difference in over those 20 years. So that was another thing that stuck out to me in this graph.
Amanda, did you have something there? I felt like you were just starting to talk before Evan.
Yeah, no, just to piggyback off yourself, Austin, especially with that 1 year, I just wanted to highlight, in 2022, that was one out of 3 whole times in history of the stock market where stocks and bonds were both down. So I always like to highlight that fact as well.
Yeah, good thought. We're typically more inverse on stocks and bonds.
Which was the hard for the moderate investor, where usually stocks and bonds, we want them to be uncorrelated, where one's down, the other's up. And to your point, in that event, both were down. And that was a bad year for even the moderate investor.
Yeah.
So as we usually mention this on our commentaries, but that graph is why we implement our philosophy, the bucket approach, where we need those funds in cash on the sidelines for those next couple of years of withdrawal needs where we don't want to worry about the fluctuations in the bond and stock market. From 4 to 6 years, that's what we're looking at for bonds, where we want to get a little bit more yield than what we'd be getting in the checking and savings account. And then anything above and beyond that, the 7+ years, that's where we're looking into the stock market to get that long-term growth. So a couple of final last thoughts here as always. Don't let emotions drive decisions. Understand your risk tolerance. Know your time horizon for funds. Be diversified. Stay invested. So now we'll open it up to the live Q&A here.
All right. Before we do this, let's talk about our retirement readiness meeting here real quick. I know I've been looking at the attendees list. I know a lot of you guys are clients, so this doesn't apply to you. But for anybody who watches the recording or is on and is not a client of our firm, we do have this retirement readiness meeting. If you've been sitting on these calls, if you've been getting value from our videos, our YouTube channel, all that, that's great. But we can't answer every individual question and really dive deep on these calls. So that's what we have this meeting for. It's a free 60-minute meeting with one of us three or one of our other advisors or coaches. And we can answer just about anything you want to know and really see if you're meeting the basic criteria to be ready for retirement and how to prepare for that. So feel free to book that call there. Like I said, there's no cost to that. So I wanted to leave that up while we're answering questions here in case anybody's interested. Now, guys, I only see one question in the Q&A, and that's just not acceptable. So if anybody has anything they've been thinking about, put it in there. But we'll start asking here, or we'll start answering here. So Tim asked, do you advocate for managing buckets in the TSP? Evan and Amanda, how do you guys feel about that?
Yep. So you're able to manage the bucket strategy in the TSP, where anything in the next couple of years that you need withdrawal wise, you could use the G fund. In the next couple of years, you could use the F fund. Anything above and beyond that, looking at the CSI. So you are able to still implement the bucket strategy at the TSP. The issues that we see with that is just the TSP is a great vehicle for accumulating assets, but when it comes to distributing, there's a way that we could be a little bit more efficient and proactive, where we use active management funds in certain areas. So the international market, we prefer to use active management there, where we have a money manager for the mutual fund who's trying to avoid the companies in the international market that are risky. And same thing with the bond portfolio, where instead of the F fund, we use actively managed mutual funds that those money managers are trying to make tactical decisions to get better yields on the bond fund too. But you are able to implement the bucket strategy within the TSP, just not really in the life cycle funds, because that's where you're losing control of your investments, where you're trusting the target date fund to do its job, which it does, but that's not really a strategic bucket strategy approach.
And the other thing, just to chip in there, Evan, I think the thing that about the TSP that makes the bucket strategy the hardest is when you get into the distribution phase of life and you start taking distributions from the TSP, you do not get to pick and choose where your distributions come from. So you can't say, hey, I want to take $10,000 from the G fund. So in preparation for retirement, before you get into distributions, you can start forming your buckets in the TSP. But when you actually start to utilize that strategy and you want to start taking distributions, it's difficult to do because you can't pick and choose where the funds come from. The way around that is you could take a distribution, and then every time you take a distribution, you change your allocation so that you have effectively like taken a % off the G fund or something like that. But that's kind of a pain to do. So yes, you can start managing it in the TSP, but that's why we see most people move money out of the TSP when they get into the distribution phase. for some of the reasons that Evan was talking about, but also in control of where those distributions are able to come from, or your control over that.
Mhm. All right, good question from Sue Sharrow here. What is the difference between the G fund and the L income fund? So all the life cycle funds, L income fund included, is really just all the different funds, meaning G, F, CSI, and a different balance within those funds. So specifically for the L income fund, it's approximately 65% G fund, close to 10% F fund, and then the rest in the CSI. So basically 70% bond, 30% stock portfolio.
Yeah, and what I was going to say with that is for anybody that's in any of the life cycle funds, actually, I would highly recommend that you go to the TSP website, tsp.gov. And when you're on the TSP website, you go to the fund options. I'm looking at my other screen over here. And then you go to the life cycle funds, and it'll actually show you the breakdown of each life cycle fund. So what I've noticed is a lot of people that are in the life cycle funds kind of just look at it as like, hey, it's this magical fund that does whatever, it's supposed to do for my age. But what's interesting is every life cycle fund, like Evan said, is just made out of the 5 core funds. It's just a balance of the C, S, I, G, and F. And if you go look on the TSP website and you go to the life cycle funds, you can actually see the balance for each of those funds. And there's 2 things that typically catch people off guard. One is there's a lot of G fund. So even when you go to like the 2040, 2045, which would be somebody who's not supposed to retire for, 15, 20 years. Let's see, I'm just going to look at one real quick. So 2040 means you're not going to retire or you don't need your money for 15 years. 21% of that is in the G fund. So 21% of that's in cash. That is not necessarily following the bucket strategy, right? That we had laid out before. That's significantly more cash than we might say you might need in that. So the other thing that surprises people is how much is in the I fund. In that same the 2040 fund, a quarter of it is in the I fund, the international fund. So 25% of it's there. And so those couple things is kind of this 2-sided coin of the TSP. They get really conservative on the G fund side, more so maybe than we would agree with most of the time, but pretty aggressive on the I fund side, or fairly risky there on the international side. So anyway, I'm elaborating on this because there's no more questions in the feed, so you guys need to get some more questions in there to get me to shut up about the life cycle funds. But to one more thing on that. On the life cycle funds is, this is something that we could talk about on the retirement readiness as well. But I don't want you to hear me say these things and get out of a life cycle fund if you are not going to be able to. This is a know yourself type of moment, right? If the life cycle fund allows you to not care about your TSP and just put money in and forget about it and not stress about how it's allocated, by all means, use the life cycle fund. Okay. Being in the life cycle fund, for all of its, pros and cons, is going to be better for you than if you're someone who, is going to be moving money around and putting it in the market and pulling it out when you get scared and then trying to put it back in again. That is definitely going to end up worse for you than being in a life cycle fund long run. So if you have the confidence to pick an allocation that you think is right for you, or you work with us, or you work with somebody to do that, then do that. But if the life cycle fund is your way to, put money in and not care about it, by all means, continue to use it for that purpose.
And
Okay, I'm done.
can elaborate on Sue's question a little bit more. What is the G fund?
You asking me? I'll go for it.
Yeah.
So the G fund is effectively it's like a government money market fund. So technically it's unique to the government, right? The G fund is only available in the TSP, but effectively it's a short-term treasury fund. which means that the way it works is effectively like a high yield savings account. The G fund is going to pay you a guaranteed rate, but that rate's going to fluctuate with where the federal funds rate or interest rates are, which is why we categorize the G fund as cash, not necessarily bonds. When you look on your TSP statement, it'll actually categorize the G fund as cash because it doesn't lose value. It just pays the set interest rate. Now, something that's been coming to light more recently as we've gotten close to government shutdowns and things like that is, and we've had some people get nervous about this, is the government actually has the ability to borrow from the G fund. So everybody that's got their money in the TSP, a lot of it's in the G fund. The government has the ability to borrow from that during a shutdown. Now, there's no precedent for any problems coming from that, right? The government's always paid it back right when shutdown ends. But that's been something that people have asked a lot of questions about to see if we're nervous about. To be completely honest, it's not something that weighs on me or a reason I think to avoid the G fund. I think the other reasons we've talked about are more so reasons to think about how much you owe there or own there, but it is something to know.
Yeah, good analysis. All right, any other questions here? See, Constance said, great analysis. Thank you all. Thank you.
Thank you, Constance.
All right, here's another one. In regards to taking distributions, couldn't you move your investments to the G fund, take a distribution, and then reallocate everything back to a 60-40 mix? Yes, you could, and that's what Austin was alluding to before. So let's say in this example, you have 50% in the S, 50% in the C, 50% in the G. You take a 100,000 distribution, but you wanted that to come from the G instead of the C. Now you're at $1 million. Now you're at 900,000, and now you're in 450 in each. To Joe's point, you could go in there, reallocate, and get it back to the balance that you wanted, where you would, instead of being 50-50, putting more into the C than the G.
Yeah. And it's something you can do. Most people, like when they get to retirement, they just want to go on monthly distributions, and to have to do that every month is not ideal, right? But it is, of course, something you could do. The other risk there is that you're missing out on the day that you allocate everything to the G fund, which could go either way for you. But if we think that over time most market days are positive, you're missing out on the returns of that day. So, minor usually, but something to consider. Now we had another question come in about a specific TSP allocation. So I'll read it and we can talk through it. But just so you know, on any sort of specific TSP allocation question like this, there's so much that has to be considered about your situation and your proximity to retirement and your spending and how much money you're going to need, that I won't be able to give a straight answer. Okay, but we'll talk through the, I guess, rationale here. Okay, so the question was, how does this allocation sound at the moment? 30% S, 20% I, 20% C, 30% G. Okay. So a couple things that catch me about that off the bat. This would be someone who is fairly aggressive, right? 70% of the money's in the market. Okay. Now, of the money in the market, they had 30% S, 20% I, 20% C. So the C fund was, a minority portion of that investment. Okay. Now, typically, if we're designing a portfolio, even with, and this is why, a lot of times we'll say when we're going through these commentaries, we'll be pointing things out like, hey, the C fund looks overvalued. International looks like it's at a good value. But what we really don't want with this is for you guys to take that and then say, oh, I need to get out of the C fund. I need to be in the S fund, in the I fund. Okay, because the C fund, when the S&P 500 over time, if we're still looking on a 10, 15 plus year, if we're looking at that into the future, I would anticipate the C fund outperforms the S fund and the I fund over that 10 years. Okay. That's my personal opinion. I believe in the US market that large US companies will likely still outperform. What we mean when we show those things is there are people that are, a lot of people when they're choosing investments, they're looking backwards, they're saying what's done the best over the last 10 years, and everything's in that, right? So there's a lot of people right now that only have money in the C fund and the G fund. Okay. And all we're saying right now is, hey, get some money spread, get some money in the S fund, get some money in the I fund. Now, to answer this question directly, personally, I would still have the C fund as probably my core equity holding. Have that as the highest percentage of equity of the CS and I, with smaller percentages in the S fund and the I fund. Okay, personally. Now on the fixed income side, this person has 30% in the G fund. That's all their fixed income. I would make an argument that there's reason to have bonds in your portfolio in addition to cash. Okay, so the G fund's all cash. It's not going to benefit from rates falling. Matter of fact, the G fund will just start paying lower rates over time as interest rates come down, where the F fund will actually benefit from that. So there's, we talked about bonds today and how this is a time where bonds are finally kind of acting like they're supposed to. They're actually paying us interest. They could act as a ballast if the market fell. And so, not to say it's one or the other, but I think right now is a time that it makes sense to have a combination of G fund and F fund for that safer part of your portfolio. So I know that's not a direct answer to your question here, but I like these questions sometimes just to talk through some of the methodology of how we go about that. But thank you for the question. Okay. No more questions. That's fine. So I guess we'll wrap it up a little bit early. Give you guys a little of your day back. So thank you for everyone who attended today. I see a lot of our clients on the call, looking at the attendees. So thank you guys. If you have any specific questions, you can reach out to us. If you're not a client and you're on this call, this retirement readiness meeting is just a great way to get a foundation set if you're interested in that for no cost. So anyway, follow along, keep subscribed to our YouTube channel, like the videos there to keep seeing them, and we'll see you guys on the next one. Thanks, everybody.
Thanks, guys.